Welcome to the deep dive. Today, we're going to be digging into Shopify's Q1 2025 results. They just came out May 8th.
That's right. We've got the official press release, plus some analysis from Guru Focus, Investopedia, and interestingly, another source also called the deep dive.
Yeah, lots to look at. And our goal here really is to cut through the noise, figure out what these numbers actually mean for Shopify's position, its future, without getting bogged down in finance speak.
Exactly. It's about understanding the signals
Yeah.
and having these different takes on the same data. That's really helpful for building a more rounded picture.
Okay, so something that kind of jumped out immediately. You see these strong growth numbers, but then headlines are shouting about a surprise net loss. That sounds contradictory.
It does, yeah, and that's where we need to unpack things. So Shopify reported 27% revenue growth year over year, hit $2.36 billion.
Which beat estimates, right?
It did, yeah. Analysts were looking for around $2.33 billion. And they also highlighted their free cash flow margin, 15%.
Right. Okay, remind us, free cash flow is basically the cash left over after running the business and investing, right? A health metric.
Pretty much, yeah. And this is remarkably their seventh straight quarter with a double-digit margin there. So, quite consistent.
That does sound solid. I saw the quote from Shopify's president, Harley Finkelstein. He seemed pretty confident.
Very. He said Q1 confirms two things. One, they're delivering growth and profitability at scale. And two, businesses just do better on Shopify no matter the market. Strong words.
Uh-huh. And CFO Jeff Hoffmeister.
He had more context. Pointed to 8 straight quarters of pro forma revenue growth over 25%. Now, pro forma often adjusts for one-offs, giving a clearer operational view.
Right.
And 7 straight quarters where GMV, that's gross merchandise volume, everything sold on the platform grew over 20%, all while boosting that free cash flow. It points to, real momentum.
Okay, let's break down some of those key numbers. Q1 25 versus Q1 24, GMV first.
Right, GMV. Total value of goods sold, it climbed from about $60.9 billion to nearly $74.8 billion. That's up 23%.
Healthy growth.
Definitely. Though, Investopedia did mention it was just a touch below what some analysts were forecasting.
Interesting. So good. But maybe expectations were even higher. What about their subscription income, the MRR?
Monthly recurring revenue, yeah. That's their steady income from platform fees. Also up strongly from $151 million to $182 million. That's a 20.5% increase.
Okay. And total revenue, we said, was up 27%.
Yep, from $1.86 billion to $2.36 billion. Really driving that was merchant solutions, but we can get into that.
Right. And profitability. Gross profit, operating income.
Gross profit rose 22%, hitting $1.17 billion, roughly. The margin held steady around 49.5%.
Okay.
And operating income more than doubled. Went from $86 million last year to $203 million this quarter.
Wow, okay.
And free cash flow, as we said, jumped 56% to $363 million, margin up from 12% to 15%.
So, all of that sounds really positive, healthy, core business, which brings us back to the big question, this surprise net loss. How does that fit in?
Yeah, this is the tricky part. Despite all that operational strength, Shopify reported a net loss of $682 million for the quarter.
That's a lot bigger than last year's loss, isn't it?
It is. Last year, Q1, the loss was $273 million. So this year, it's swelled by 150%. And Investopedia called it a surprise because analysts were actually predicting a profit.
How much profit?
Around dibbles and 17 cents per share was the consensus. Instead, Shopify reported a loss of 53 cents per share. Big swing.
Okay, so what caused that massive difference? Where did the loss come from?
The main culprit, a big hit on the value of Shopify's equity investments. The deep dive source put the figure at $908 million. Investopedia just said over $900 million.
There's equity investments. So stakes Shopify holds in other companies.
Exactly, often private companies. Their value goes up and down based on market conditions, their performance, whatever. And those changes, even if they're just on paper, flow through to the net income line.
So it's not about Shopify's core operations losing money. It's about the market value of their investments falling.
That's precisely the point Shopify's management is making. The CFO, Hoffmeister, stressed that if you exclude these investment impacts, their adjusted net income was actually $226 million.
And how does that compare to last year?
Up 57% from $144 million last year on an adjusted basis. He basically argued these investment valuations don't really predict their operational success.
Right.
Although Investopedia did note that even this adjusted EPS, earnings per share, at $1.25, was just a penny under what analysts expected.
Okay, so a really crucial distinction there. Operational strength versus these like paper losses on investments. Shopify saying, look at the core business, it's doing great.
That's the message, yes.
Hmm.
The underlying business is resilient, despite these external mark-to-market hits.
Makes sense. Let's look at their segments. Subscription solutions versus merchant solutions. How did they do?
Subscription solutions think platform fees grew a solid 21%, brought in $620 million.
Okay.
But merchant solutions, that was the real growth engine. This covers things like payments, shipping, capital loans,
Right.
basically services merchants use on the platform.
And how much did that grow?
It jumped 29%, reaching $1.74 billion. It's driving the overall revenue growth.
So what does that tell you?
It tells you Shopify is becoming much more than just a storefront builder. It's embedding itself deeper into the merchant's whole operation. Payments, fulfillment, finance. That stickiness is huge.
Yeah, that makes sense. As their merchants succeed and use more services, Shopify earns more. That seems like a powerful model.
It absolutely is. It shows their strategy of building out that ecosystem is paying off.
What about costs, operating expenses? Did they keep spending under control?
Operating expenses did go up by 11% to $966 million. The main drivers were sales and marketing up to $405 million, and R&D, research and development, up to $377 million.
So investing in growth and new features, basically?
Seems like it, yeah. You need to spend to attract merchants and keep the platform competitive. Makes sense.
And overall cash flow, beyond the free cash flow number.
Well, net cash from operating activities was very strong, up 54% at $367 million.
Yeah.
But their actual cash pile, cash and equivalents, dipped slightly. It went from $1.5 billion at year-end 2024 down to $1.31 billion at the end of Q1.
Why the dip if operating cash was strong?
Mostly because they deployed capital. They originated $805 million in loans, likely through Shopify Capital, and spent $56 million on an acquisition. They did get cash from maturing securities, but the outflow for loans in the acquisition was bigger.
Got it. So actively putting money to work, investing in the business and maybe their merchant base through loans. Okay, what about the outlook? What are they predicting for Q2?
They're guiding for revenue growth in the mid-20s% range year over year. So still strong growth expected?
Similar to Q1 then.
Roughly, yeah. Gross profit dollar growth expected in the high teens% range. Operating expenses as a percentage of revenue, they see landing between 39% and 40%.
And free cash flow.
They expect the margin to stay strong, similar to Q1 in the mid-teens. So overall, it suggests they see this positive operational momentum continuing.
Okay, seems like they're still confident internally. What are the analysts saying about all this? Guru Focus had some takes.
They did. Generally optimistic, actually. They reported an average analyst price target of around $133 per share.
And where was the stock trading when they reported that?
Around $94.50. So that target implies like over 40% potential upside from that point.
Yeah, okay.
And their consensus rating from, I think it was 48 brokers, was 2.2, which basically translates to outperform.
So analysts are looking past the headline loss, perhaps.
It seems that way, yeah.
Yeah.
Guru Focus's own internal valuation metric, their GF value, also suggested upside potential, over 20% based on their calculation.
But they added a note of caution.
They did, just advised investors to keep a long-term perspective, even with the positive signs. Standard advice, really, but worth noting.
Right. So analysts bullish long term. But what was the immediate market reaction to the earnings news? You mentioned the surprise loss.
Yeah, Investopedia reported the stock fell Thursday morning right after the announcement, down about 5% pre-market, and it put the stock about 11% lower than the start of the year at that point.
So the market definitely reacted to that net loss figure, didn't it?
Yeah, it seems so. Even if it was driven by those non-cash investment write-downs, that bottom line number clearly spooked some investors in the short term.
It really highlights that disconnect sometimes, doesn't it, between operational metrics and the GAAP accounting bottom line?
Absolutely. It shows how sensitive the market can be to headline numbers. Even when the company provides adjusted figures in context, GAAP net income still carries a lot of weight.
Okay, let's try and pull this all together. What are the main takeaways for someone trying to understand Shopify's Q1?
I think, first, the core business looks healthy. Strong growth in revenue, GMV, and especially that free cash flow. Operationally, things seem solid,
Oh, that's...
but that big net loss, driven almost entirely by those equity investment write-downs, really hit the headline number and clearly impacted short-term market sentiment. Management's message is, focus on the operations, the adjusted numbers are strong, and the outlook for Q2 is positive. And longer term, many analysts seem to agree there's value here.
So what does this mean for you, the listener? What should you take away?
I think the biggest thing is realizing You have to look deeper than just that main net income figure. You need to understand why it looks the way it does.
The difference between operations and investment fluctuations.
Exactly. That net loss looks alarming on its own, but when you see the operational strength, the adjusted profit, the positive guidance, it paints a different picture of momentum.
And the analysts seem to back that up, mostly.
Generally, yeah. They seem to be looking at the long-term potential. So if you're tracking Shopify or even just e-commerce trends, these results show a company growing robustly, managing costs pretty well, but also dealing with the volatility of external investments on its books.
That's a great summary. So it leaves us with a thought to chew on, perhaps.
I think so. It really makes you wonder, how much weight should we as observers or investors give to these non-cash items, like these big swings in investment values? How do they truly tell us about the fundamental health or the future of a company like Shopify compared to its core operational result?
Yeah, it's complex. This quarter really highlights that you can't just read the headlines. You've got to dig in.
Definitely.
Okay, thanks for joining us for this deep dive.